High or low? What's my mortgage rate going to be in 2023? Let's talk about how mortgage rates are decided. Obviously, you want to get the lowest rate possible for your mortgage. But how are mortgage rates determined, and what can you do to help make sure that you get the lowest rate possible? There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect, and that is your own personal factors. Lenders look at those qualifying factors to determine your risk level. The better your qualifying factors, the lower your risk level, and the better the interest rate that they can offer you. So first, let's talk about the parts of the mortgage rate that you have no control over, and that's the economy. Mortgage rates are affected by the overall economy. When the economic outlet's good, then interest rates tend to increase, and rates fall when things aren't looking so great. The inflation rate, the pace of job creation, and whether the economy is growing or shrinking will have an impact on mortgage rates. The Federal Reserve does not set mortgage rates, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them based on the state of our economy. While mortgage rates aren't directly tied to the Fed rates, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly after. You see, the Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, the Fed lowers the rate. And when the Fed decides that they need to tighten up the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their costs to borrow money from the Fed. Now, which personal factors affect your mortgage rate? You certainly cannot control the economic factors of mortgage rates, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best mortgage rate possible, beginning with your credit score. A high credit score means that you are less of a risk to a lender. This shows that you pay your bills on time and you don't overextend your credit. When lenders pull your credit, they see you as a very responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you are a higher risk of default for the mortgage that you are getting. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you are using. If you want a conventional loan, you'll need at least a 620 credit score. But if you choose FHA financing, we can lend with a score as low as a 580. But like I said, the interest rate will be much higher if you have a very low credit score. Taking steps to check and improve your credit will put you in a better position to get a lower interest rate when you go to get your mortgage. The next factor that you can control is your down payment. The more money you have invested in the home as your down payment, the less likely you are to default. In other words, you have skin in the game and you are less likely to walk away from your home and let it go into foreclosure. If you put down less than 20% on your home, your mortgage rate will increase and you'll need to pay mortgage insurance. There are different types of insurance depending on your loan program. Some are cancelable and some are not. Besides mortgage insurance, if you put down less than 20% on your home, you'll also pay a higher interest rate. You are at a higher risk of default with a lower down payment, and lenders make up for that risk by charging a higher rate. Next, let's discuss occupancy. Lenders care about whether your purchase is for a primary residence, which means that you will be living there and making it your home, versus if you're going to purchase a house for a vacation home or an investment property. Interest rates are usually lowest on primary residences because it's where you live. You are more likely to make your payments on time because you do not want to lose your home. If you have a second home or an investment property and you run into financial issues, you're more likely to default on that mortgage versus your primary residence. Most lenders charge a higher rate to make up for this risk. The bottom line is that both market and personal factors affect your mortgage rate. While you cannot do anything about market conditions such as unemployment and inflation, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways to improve your chances of securing the best mortgage rates. So, 1. Be sure to take care of what you can control by looking closely at your personal factors and make them as good as possible to ensure that you get the best interest rate when applying for a mortgage. 2. Work with a licensed mortgage professional. And 3. Ask questions. Thank you for watching this interesting video on interest rates. My name is Chrystal Searcy with Homestar Financial, helping make the mortgage process crystal clear. If you or someone you know is looking to buy or refinance or just get your questions answered, please contact me at the information below. Bye.